Okay, so the topic what we have for today is basically your financial assets and liabilities. This is covering up with IFRS 9 and IS 32. Okay, so now before we jump into the topic, I would just like to understand from you guys that when it comes to financial instrument, like what is it basically? Okay, so if you have any interpretation with regards to financial instrument, you can share it, and then I can tell you exactly that what a financial instrument is basically. Any idea?
So it's more about financial asset and financial liability, like monetary asset, monetary liability, cash and cash equivalents, receivables, investments, accruals.
Correct. So basically what you're trying to tell me is that you're giving me examples of financial instruments. Agreed on that. Okay. But well, actually, a financial instrument is basically a contract. Okay. It's a contract between two parties in which for one party it will become a financial asset, and for the other party, okay, it could either be a financial liability or a fun or an equity. So basically, when you talk about financial instrument, it's actually a contract between two parties. The first party, you can call it as your investor, and in this whole class, in this whole video, uh, I will be the investor. So okay, so you need to understand that I will be the investor and you guys would be the investee actually. So that's me. First party, that's the investor. But then the second party would be you guys, and that's going to be the investee. Okay. So now we need to understand the party from like I'm talking about myself. I'm the investor. So for me, it will become a financial asset. Okay. But for you guys, it could either be a liability or it could be an equity. The first thing what we will be understanding over here is that how will we segregate or differentiate between if it's a financial liability of yours or if it's an equity of yours. Okay. Now, for example, Arish invest. So you see, I'm the investor. For me, it's a financial asset actually. Arish invest $1,000 in student company shares. Now, you do understand that from my side, RS side, the investor side, it's for me, it's a financial asset. I have done an investment over here of $1,000 in student companies' shares. Okay. Now, my question is, what is it for you? Is it a financial liability of yours or is it an equity of yours? What do you think?
It is an equity, right, sir?
Okay. So you say equity. Can I have other anyone else? Ashu, what do you think? What is it going to
I
be?
I I mentioned the same. I mentioned the same equally.
You can chat with me also. If you want to type a message, you can chat with me. I can see the chat also. It's perfectly fine. Okay. Let's have an interactive session so that we can understand each other and the concepts too. Equity. Now, is it because you are telling me that it's written shares over here, and that's why you're saying that it's an equity? I mean, is that the logic what you're using to differentiate?
Sorry. Actually, I didn't read the line completely. So it can either be a financial instrument, maybe shares or other like loan notes or whatever it is. It can be anything.
It can be anything. Okay. So one response is that it's an equity, the other response is it can be anything. Now, see, the point is how will you distinguish whether it's a liability or an equity is based on obligations. Okay. It's all basically it's a contractual thing. Okay. So your answer should have been that we will see the contract between the Arish company, like Arish and the student company. Like, what is that contract about? Now, in this contract, for example, if it's your obligation that you have to pay me something on the invested amount, like every year you have to pay 5% dividend or 10% dividend, or you have to pay anything on that amount. So, in that case, if there is an obligation, it becomes a financial liability. But in case if there is no obligation, then in that case it becomes an equity. So as if I am investing in your company, students company, if you are bound to pay me a dividend every year, in that case, even though I call it as shares, it won't be considered to be as shares. It's not an equity, it's actually a financial liability. You have to treat it correctly and you will record it as your financial liability. But if in the other case I have invested $1,000 in your company and there is no obligation for you to pay me anything back, okay, if the directors of student company decide to pay me a dividend, that's another story, but you don't have any obligation over there. Directors are under no obligation to pay the dividends to the investors. Actually, if they think that it's their best use of their money, they pay it back as a dividend. If they think that, you know what, let's reinvest the money back in the business, so in that case they are under no obligation, they are under no legal obligation to pay the dividends to the investors. Actually, only in the cases when they want to give, they will announce or declare the dividends. So the point of classification is in any kind of an contract, because I said you that when I ask you that what is a financial instrument, I would say it's just a contract. Okay, the definition of financial instrument is it's just like a piece of a legal paper. It's a contract in which for one party it becomes a financial asset, but for the other party it becomes a financial liability, or it could be an equity. Now, depending if the investee has an obligation to pay anything back to the investor at a fixed time or at an interval or whatever it is, in that case, the investee will consider it to be as their liability. But in any condition, if the investee, your company, the student company, has no obligation to pay me whatsoever, in that case, you will consider it to be as your equity then in that case only. Hope the concept of distinguishing between financial liability and equity is clear.
Yes, sir.
Okay. Okay. Now, so we will first discuss from the financial asset side. Okay. And then I'm going to reverse it, like it's like a mirror image for the financial liability side, basically. So I'm talking about financial assets now. So basically, I'm talking about myself in this case. I'm talking about from the investor side. So you have to read the question very carefully in the exam, that who is actually doing what, like where is the entry or where is the question actually starting from? Is it from the investor side point of view, or is it from the investee side point of view? Okay, so I will tell you how to identify that also, but for right now let's start with financial assets. Okay, and either I am investing in your equity. Okay, so first we will cover up with equity, and then the second part what we have is that we cover up debts basically. Okay, so now let's say this is an example again. students' company have a total share capital of $10,001 ordinary shares. So that's your share capital. You have 10,000 total number of shares. The nominal value is $1. Okay. And that's your total share capital. Now, please try to understand the link between the different standards also. Okay. Irish company purchases 6,000 shares. Okay. I can say student company have a total share capital of $10,001 ordinary shares. Okay. And Irish company purchases 6,000 shares from that 10,000. How much percentage I am buying of your company?
60%.
60 percentage. Correct. 60. Now, assuming that obviously like that 60 percentage, do you think it will give me the control of the company? Because if you have more than 50 percentage, right, it's you can assume that Irish company has got the control of the student company. Now, if that's the
Yes.
case, right, 60 percentage ownership, then in that case you need to understand that the standard what is relevant and we will apply is IFRS 3, that's business combination. I need to consolidate your company into my company accounts actually. This will call for a consolidation because the investor has obtained more than 50 percentage voting rights or the share capital of the investee. In this case, you become my subsidiary, I become the parent company, and as per law, the parent company has to consolidate the accounts of subsidiary company as well as the parent company and show them as one group. Okay, this was case one. Now, in another case, for example, Irish company has purchased only 4,000 shares from that 10,000 $1 ordinary shares. Now, what's the percentage of ownership in this case?
40%.
40%. Do you think I do have a control on your company now?
No, you'll be as associate, right?
Exactly. Correct. It will be, we can assume, okay, that it can be as an associate in that way. Because in this case, like when I had the 60 percentage ownership, okay, here I got the control. And that's why I had to use IFRS 3 business combination, which is consolidation. But when it's 40 percentage ownership, I don't get the control. What I get is normally an influence actually. Okay. I can influence your operating and financial policies. So I get a significant influence over here. And in this case, as you said very correctly, that we will be using IS 28, which is investment in associates and joint ventures. I mean, that's the full name of it. But anyways, you don't need to know about joint ventures now. Anyways, so that's case two over here. Okay. Now, this is what is related to what you are studying and the topic of today's class, which is case number 3. Irish company has purchased only 1,500 shares from that 10,000 $1 ordinary shares. Now, do you really think that it gives me an influence on your policies or it gives me a control over it?
No, no.
No, no.
Got it? It's only basically 15 percentage. So anything which is less than 20 percentage, because okay, these are all rules of thumb actually. Huh? I mean, we don't actually in practical and in even in SPR syllabus, you won't be going on terms of numbers actually, but this number thing, what I'm doing right now is just to clear your concepts right now. So we assume that if you have more than 50% share capital of a company, if the investor has more than 50% share capital ownership of another company, we assume that we get the control. If it's between 20 to 50, we assume that it's a significant influence. But the bottom line depends on the practice, okay, on the reality of the question or the information that will be provided to you in the question. So we are not going in that area, but right now I'll come back again to the topic, which is that in this case, if it's 15% ownership, okay, so neither we have a control over here, and neither control or neither nor influence. So in this case, we use IFRS 9, which is your financial instruments. Okay. So you do understand now that depending on how much percentage of ownership the investor is acquiring in the investee, the standards will be decided. So if you are in the first 20%, it's simple IFRS 9 financial assets, financial instrument. Then from 20 to 50, it becomes associate. And then from 50 onwards, 100, it becomes a control and consolidation, and IFRS 3 comes into action. Right. So now we will stick with this one, which is
Sir,
case
sorry
3.
to interrupt.
Mhm.
Sir, do they ask case one and case two, or do they really ask case three? Like to focus on case three?
For this class, case 3.
Uh, no, no,
Overall
no, no.
syllabus, you need to know
Yeah.
all 3 for sure.
Okay. Okay.
Okay. This,
Case 1 and 2 are asked in section C only, na?
yeah, one and
Like most of the time.
exactly. Yes. In section C type of question, you will be getting consolidation, and even though in MCQ, so that's where they will test the concept of associate and the subsidiary, correct?
Okay.
But this
Okay.
can also come in section C, where they might give you that, okay, you have this one small investment, in individual accounts, for example. So it's basically going to be a part of the whole big question, basically. But yes, financial instrument, this chapter can specifically come in section B. Like I'm going to share a question which is from the exams, like previous session, which was a purely 10-mark question based on this chapter. So you will see it very quickly. Okay.
Sir, one more thing I need to ask. In the section C, we are basically most of the time it may be a single entity question for consolidation and an interpretation. We might get choice between three. Okay, so
Yeah.
I do have done the consolidation and interpretation part, but I haven't practiced single entity yet. So I just wanted to know, like, single entity is just a combination of all the ISs till now, like
Yes, correct.
uh,
Yes,
given
correct.
in our book, right?
Yes, yes. So if you have done the IS and IFRS actually, which will be in the notes to the account. So basically through IS and IFRS, you prepare the accounts of a single company, right? So if you have, let's say now
Yeah.
there are a couple of standards which are quite important for attempting a single entity question. Let's say IS 16 is quite important, IS 12 is quite important. This class, what we're doing right now, it's important. IFRS 15 is important. These 4 standards will be 100% sure in every paper. Okay. Like if there are 6 to 7 adjustments, 4 adjustments, I can tell you that the first adjustment will be on depreciation, I-16. One of the adjustment will be on taxes, which is income tax and deferred tax. You might get revenue. That is also upcoming and trending topic for the examiners. And you might also get one part of financial asset or a liability. It could be as we will see that we have compound instrument, or we have loan notes, or we have preference shares, something like that. So these 4 points I can assure you that you will get. The rest is your luck, basically. So maybe you might get leases, maybe you might get inventory, maybe you might get some other standard, but those 4 which I have explained you, 12, 16, IFRS 9, IFRS 15, I mean, you won't find any question in the revision kit while you're practicing the single entity accounts that these 4 standards were not being tested. It will be there for sure.
And actually, since you are using this PDF, sorry, not PDF, Word file, so will you be sharing this PDF Word as
Yes,
well?
once the session is concluded, I'll be sharing the recording as well as the PDF of this.
Because I was writing it down, but somehow I haven't written the whole thing, so
No,
that's
no,
why I'm
don't need
asking.
to write down all of the stuff. You will be shared with the Word document as well as the recording. But yeah, some questions like when we will be doing it together, for example, I will give you time to record it or to see how the workings go. So don't worry about that.
Okay, sir. Thank you.
You're welcome.
Now
Any
you can,
question?
sir, continue, sir.
Yeah. Uh, Aditya, any problem? All good so far?
Yeah, yeah, sir. All good, all good.
Okay. So now let's obviously we will dig more into this case 3 right now. Okay. So let me put some information for you and then I can explain it out. So in this case, see, the student company has, let's say, $1, 10,000 ordinary shares. Okay. Irish company acquires 1,500 ordinary shares. Like one is the nominal value for a market price of $5 per share. Irish company also paid transaction cost of $1 per share. Okay. During the year, student company gave a dividend of, let's say, 0.5 per share, and the market price of student company's share at the year end was 7 per share. So that's the maximum information you can get in this type of a question. Okay. So we do have agreed that it's basically going to be treated as per IFRS 9 financial instrument, financial asset, because I haven't got the ownership or the control of your company, right? So it's basically only 1,500 shares, what I have. Okay, so that's 15%. So it's not giving me control or the influence. So I just have to treat it as an investment, as a financial asset. Now, see the options, like if you talk about the initial measurement, okay, of the financial asset, it is going to be at a fair value. That's the technical name for it, which is considered to be as the fair value. Or if you want it in a more easy way, it's the or the consideration paid. And subsequently, like after the initial measurement, you have an option that either you go with fair value through P&L or you go with fair value through OCI. Now, though I have taken a lot of technical names right now, now I'm going to explain it to you. What do I actually mean? See, for me, I told you at the start of the class that right now what we are covering is how I am going to record that investment, okay, from the investor side. Now, in this case, when I'm buying the shares, okay, I have to decide one thing. This decision cannot be changed. And what is it? What's the purpose of me as an investor buying your company shares? I can have two intentions over here. The first intention could be that today I'm buying it at, let's say, 5 per share. Tomorrow it will be at 7 or 8 or 9, and it will, it will be, the price will increase. I will sell it and I'm going to get profit onto it. If that's my intention. So this is considered to be as those shares are held for trading purposes. And that's where you use the option, which we call it as fair value through P&L. So if nothing is written in the question, it actually means that it's going to be for trading purposes. This is basically considered to be as a default position, that if nothing is written in the question, it means that it's going to be held for trading purposes. However, practically, whenever a company buys shares of any other company, they have to tell at that time of buying the shares that what's the purpose of buying it. Either your intentions could be for short term trading, like once you buy it at 5 and then later on if it becomes 6 or 7, I'm going to sell it and I'm going to make a profit onto it, actually, if that's my intention. Or it can be to hold it for long term purposes. Okay, so in that case, see, today I have 15 percentage ownership in your company. My intentions are that I will not sell it. Tomorrow again, my intentions are that I'm going to buy more shares in your company, and it might become, let's say if I buy another 10 percentage shares in your company, so already I had 15, then plus 10 it becomes 25, and then I will get an influence over your company. So my intentions are in long term. Okay, my intentions are that I won't sell the shares, but my intentions are that over the passage of time I will keep those shares. I might buy new shares of your company and make it as my associate, and then I can buy further more shares, and I can control over your company. So whatever the investor's intentions are, it has to be disclosed to the market where you're doing the transaction. It's confirmed. Once you have decided to do one thing, you cannot shift positions actually. So either you have decided that you will keep it for trading, or either you have decided you will keep it for the long run. You cannot change the option from A to B and B to A like that way. Okay. So in case if the investor has decided that I will be keeping it for short-term purposes, the option what is available for you is something called as fair value through P&L. But in case if the option by the investor decided is to keep it for longer run, in that case, the fair value through P&L option doesn't exist for the investor. Then I have to record it through something called as fair value through OCI. So in your financial reporting syllabus, there are only two things which will be recorded in the OCI. Number one is your revaluation surplus, because whenever you have a gain on the revaluation, you record that thing in the OCI. Second is this, what I'm trying to explain. So as an investor, if I have purchased your shares for long-term purposes, then the option for that type of investment is not through PNL, it's through OCI. So these are the two things which will be recorded in OCI in your financial reporting syllabus. If you go in SBI syllabus, there are other things also to be recorded in OCI, but that's not we are discussing right now over here. Okay, so right now, these entries, what I will do right now is for short term. So what I mean is fair value through PNL. Okay. Now see, my question to you guys is, how much did I spend money buying on these shares?
Is it 9,000 rupees?
How did you get?
That is 1,500 into 5
Yeah,
and
only that much. Only that
transaction.
much. I need only this much. Okay. Like for the shares, I'm not talking about the transaction cost right now. What I'm trying to talk about is the money which you paid for the share. 9,000 total agreed, 100 percentage. But right now I have paid 5 per share. So for 1,500, it will become 7,500. Correct? So the entry will be debit financial asset. Okay, it's my asset. You're talking about from the investor side, RS side. So financial asset debit, and I will write down the name of that asset, which is investment in student company shares. And I'm going to do it with the amount of $7,500. And credit will be bank or cash with the amount of $7,500. Any problem? Aditya or Ashu?
No, sir, all good.
No, sir. No, sir. All good.
Okay. Now, see, that's the first difference what I'm going to be trying to explain to you. Aditya, that you said you have to do it at 9,000. You said you have to add up the transaction cost. The point of differentiation over here is if the shares have been held for trading, that's short-term purposes, transaction cost will be expensed in the income statement. Okay. So in this case, how did I got this 7,500 is basically there were 1,500 shares and the market value of this share was 5 per share. So I got my 7,500. But the rule over here is that if the shares have been held for trading short-term purposes, transaction cost will be expensed in the income statement. So in this case, I'm going to say debit expense transaction cost, and that's going to be a part of my income statement. And the total amount will be, let's say it's $1 per share, so 1,500 expense. So that 1,500 will be in the income statement, and credit it will be cash or bank with the amount of 1,500.
So sorry to ask, but can you just explain me what is the meaning of this expensed in income statement, like in layman's language?
It's an expense. You will put it into the income statement.
Okay, okay, understood. As in debit side.
As it on the debit side. See, try to understand this point. As a marker, we are not concerned that what do you call it? You call it transaction cost. I don't care what you call it. But the fact is that you are putting it on the correct side or not. You showed me that you're putting this thing in the income statement. Do you see this IS basically?
Yeah, yeah.
This has given a clear indication to the examiner, to the marker, that you know that this expense is to be recorded in the income statement, not in the OCI, it's in the income statement. It's not to be capitalized. So basically, you have conveyed your message to the marker in two words, two alphabets, that I understand that the transaction cost been incurred on the acquiring of investment if it's held for short-term purposes is to be in the income statement.
Understood, sir.
Okay. I guess the net is dropping or something. Anyways, okay. So that's first part. Okay. Now, but let's see the difference. Okay. If this would have been kept for long term, which is fair value through OCI that. Now, here you need to understand that the transaction cost will be capitalized. So if I treat my investment for the short-term purposes, then the transaction cost is going to be expensed out in the income statement. However, if I'm going to keep it for the long term, then in that case, the transaction cost will also be capitalized. So I don't have to put them in the income statement. I would have to include it as part of my financial asset. So the rule is the transaction cost will be capitalized instead of expensed in the income statement. So now in this case, the entry will be debit financial asset, but not with only 7,500. As you said that it will be at the amount of $5 for the market price and $1 for the transaction cost. So 1,500 multiplied by 6, I'm going to be getting 9,000. Yeah. And credit will be same again, bank with the amount of 9,000. Any questions so far?
No. Thank you, sir.
Okay. Now that's at the starting. Okay. This entry, what we did in both the cases was at the initial measurement. Here also and here also. Now, during the year, obviously, see, if I'm investing money in your company, I might expect some returns out of it. And you have given me, student company gave a dividend of 0.5 per share. So that's the income which I have got from your company, from students company during the year. Okay. So either I keep it through PNL or I keep it through OCI. There is no difference in how you are going to treat this dividend income. I mean, it's exactly same. It doesn't depends on whether you are keeping it as long term or short term actually. So in both the cases, the entry will be debit cash because I got money. That's around 0.5 per share multiplied by 1,000 shares. How many shares were it? 1,500.
1,500.
1,500, yeah. So 1,500 shares. So that will make it up to 750 actually.
750. Yeah.
Exactly. So cash debit by 750 and credit will be my income statement. I can say dividend income or other income or whatever you call it. But you do understand that I'm highlighting it with the IS, which means that I do understand that it's part of the income statement. So that's 750 over there. So either you keep the investments for a longer period of time or you keep the investments for a shorter period of time. In both the cases, it will be recorded in the income statement. Okay. So
Yeah.
this is basically for the dividend income. Hi, Salma. How are you? Okay. So, so just a brief review, Salma, for you, and then we can move further. Okay. So here, if you see the fact that you guys, basically the student company has $1. This $1 is basically the nominal value, 10,000 ordinary shares. Okay. And from that, I, as an investor, have acquired 1,500 shares, nominal value at $1 for market price of 5 per share. And I also paid a transaction cost of $1 per share while I was purchasing your shares in your company. And during the year, the student company gave a dividend of 0.5 per share, and the market price of the student company shares at the year end was 7 per share. So from the now it depends that whether I have my intention is to hold that investment for longer period or for shorter period. If my intentions are to hold it for short term trading, like I might buy it at low and sell it at higher price, in that case, the option what I will be using would be fair value through PNL. In that case, as I already explained you that the transaction cost will be expensed off, So that 1,500 of the transaction cost, which was $1 per share at the rate multiplied by 1,500 shares, it will be expensed off in the income statement, but the rest 7,500 will be capitalized. That's the case if my intentions are to hold your shares for short term and for trading purposes. However, if my intentions are to keep the shares for the longer run, then in that case, the transaction costs are not to be expensed off. They are to be capitalized in the balance sheet along with your financial asset. Okay. So in that case, instead of debiting or capitalizing the investment at 7,500, I did it at 9,000, which included the transaction cost. Selma, any questions so far?
So one question.
Yeah, sure.
The information which you provided into the question, is that a sample of what they can ask in MCQs?
Or section C also.
Okay, okay.
Okay. Right now, my advice to you is that you understand the concept. How it comes in the exam, that's another story. I will help you out with that. Okay.
Yeah,
But
yes, yeah, thank you, sir.
you're getting the point. You need to separate both of these things because my point over here is to make you understand the concept. And then I'm pretty much sure, like that's I'm speaking out of my experience. Like 90% of students don't even, have a difficulty in understanding the exam question. Okay, you will understand it just because you have to make your concepts a little bit stronger way. Okay, so Ashu, are you back, right?
Yes, sir.
Okay. Anyways, I'm recording the lecture, so anything if it's messed up, you can view it back anytime, no problem. Okay. So
Yeah, sure.
now you see that I told you here that okay, so this part of the question or this part of the information was basically at the time of recording the transaction, initial starting. Okay. Then this thing happened during the year. During the year, the student company gave a dividend of 0.5 per share. So that's the next part of the information. So you see, I've divided this information in three parts: starting, during, and end. So starting difference is that the transaction cost will be capitalized if you are going through fair value through OCI, long term. If you are planning, like I am planning to hold the investment in your company shares for short term, I am going to record it through fair value through PNL, and in that case, my transaction cost will be expensed off and not capitalized. Dividend income, which I got. Obviously, if I'm investing in a company, I might be expecting some returns from it. Okay. I do understand that you're not under the obligation to pay me. If you were under the obligation to pay me anything, it would have not been your equity, it would have been a liability then. Okay. So, but anyways, you decided to pay me a dividend. Thank you very much. The entry for that dividend will remain same. Either I am recording the investment as a short term or as a long term. So the entry for that is over here, which I explained that cash, obviously I'm going to get the cash. So cash debit by 750 because I have 1,500 shares in your company and per share I'm getting 0.5. And that dividend income will be credit in the income statement. You can show it as other income, like after your operating income, you can show it as your other income like dividend income, and you can show it over there as 750. Here also, if I have kept the shares for long term, the dividend income transaction doesn't changes, it will remain same. So there's no difference over here. Okay. However, now this is the last part which is happening at the end of the year, which is the market price of the student company shares at the year end was 7 per share. So now what has happened is by the end of the year, there is a change in your share price. It went from 5 to 7 now. Okay. So the rule is that all these investments will be recorded at fair value at the year end. Okay. But where will that gain and loss go? That's debatable. Okay. So if I have kept the investment in your shares for a short-term purposes, then now watch here at year end. Okay. So this is happening at year end. Those 1500 shares are now at a valuation of 7 per share. So this will become 1500 multiplied by 7. It will give me 10,500. So how much I recorded when initially I purchased it for 7,500. But that same investment now is at 10,500. So this has basically increased by 3,000 actually. And this 3,000, because it's short term, it says fair value through PNL. So it means that you have to record the investment at fair value and any changes will be recorded into the PNL, which means the income statement. So what I'm going to do over here is debit financial asset, which is the investment in student company shares, and I'm going to increase it in value by 3,000. But the credit, it's an income. So that gain on fair value of investments, but this will be recorded in the income statement then with the amount of 3,000. Any problem with this?
No, sir.
No, sir.
Salma, all good? Okay. Hanana, welcome. Whatever you have missed, you will be shared with the recording so you can see that and try to get along with us. If you have any question, please feel free to ask. Okay, so now this is something what I can do to help you with the preparation of income statement, like the single entity account, which you're expected to get in section C. Okay, so try to understand with this point. In income statement, I'm going to be writing down basically three things. Number one is the transaction cost. How much did I spend on transaction cost? 1,500. So that transaction cost will be recorded in the income statement at 1,500. See, try to understand this point. Don't make an issue out of it. If something is written in the question that you have to include it in cost of sale or in operating expenses, you follow the question. If nothing is written, you are the king. You can use your common sense and can record it anywhere. Obviously, you will not record transaction cost in cost of sale or like in tax expense, for example. But use common sense and write it down as other expenses or wherever you want to do it. Questions are quite friendly with you. They normally tell you that, okay, if this is the thing, you record it in the administrative expenses or you record it in cost of sale. So if the question is telling you something, you follow it. If not, use your common sense and you have the freedom to put it wherever you want. The markers are not going to deduct any marks that why did you put it over here and not over here. No. If they have said you to do something, that's another story. But in case if they are giving you the freedom to decide, then use common sense and just try to take that figure into your main format of the income statement and the balance sheet, whatever it is then. Okay. So transaction cost 1,500. That's the first thing. Second thing, there will be a dividend income which you are getting from this investment. That's 750, but I'm going to write it down in negative because the transaction cost, I've written it in a positive. So 750, it's written in negative. So you do understand that that's an income and the transaction cost is basically an expense. And there has also been a fair value gain on investments, which has been 3,000, and that also I'm writing it down in negative. So to make you understand that these are all the incomes and transaction cost was only an expense. So that's these are the three figures you have to take into your final income statement once when you have interpret this question, which involved me, Arish, as an investor. Okay, like you're preparing my income statement and balance sheet actually. So when you're preparing my income statement and balance sheet, and if this is the transaction which I have done, so your income statement should contain these three elements, and the marking would be half mark, half mark, half mark, 1.5 mark for this particular adjustment what you have done. Likewise, if I go in the balance sheet, when you're preparing my balance sheet, you will write down under the non-current assets, okay, non-current asset, sorry, in this case, it will be a current asset because my intentions are to sell it within 1 year. So you will write down over there financial assets, okay, investment in student company shares, and it the year end value was 10,500. So that's what you're going to be doing it in when you're preparing the balance sheet for Irish company, because you are writing down the transaction for me, the investor side. So this in the exam will give you half and mark separately. So total mark for this adjustment will be 2 out of a total of 20, and this is how you will get the mark. So if your income statement contains the transaction cost, give them half mark. If it contains the dividend income, give them half mark. If they have the fair value gain on investment calculated correctly, give them half mark. If in the balance sheet I can find financial asset value, give them half mark, or this might be 1 mark, because if you show it as a non-current asset, you might be doing wrong. So you need to present it correctly in the current asset, because this is short term, this is not long term actually. So you get like 2.5 to 3 marks per adjustment, and this is how the marking goes basically. If you have any question, please ask before I move to the next one, where the shares are being invested for long term and we use fair value through OCI. Yes, Aditya, any questions?
No, sir.
Better now?
Yes, yes.
Ashu, any questions? Hanina and Salma? Okay. So now let's move to the next part, which I said you that we will be discussing if I keep the shares for long term. Okay. So if that's the case over here, we did already valued it over here, so I don't need to do it again. So at the year end, the valuation of those shares is basically 10,500. And you do see that initially when we recorded, we did it at 9,000 because we included the transaction cost in that perspective, right? So if you have done that 9,000, now it's 10,500. So the gain will be 1,500 only. Okay. So I'm going to say debit financial asset again with the amount of 1,500. Okay. And credit will not be the income statement, it will be other comprehensive income. Or if you're making the balance sheet, you call it as your other components of equity with the amount of 1,500. So, number one difference, transaction cost will be expensed off if you are recording it under the fair value through P&L. Transaction cost will be capitalized in case if you are holding the investment for longer period of time. Dividends being received from these type of investments are recorded exactly the same way. It doesn't depend that whether you were having it as fair value through P&L or whether you were keeping it on fair value through OCI. At the year end, you have to revalue your investment back again to its fair value. And if there is any increase, if it's for short term, you have to take it to the P&L. But in case if it's for the long term, then you have to take the gain or the loss in the OCI. Okay. So now I will quickly give you the income statement extracts from here too. In income statement, I am not going to write down anything except the fact that I got a dividend income of 750. because here I don't need to write down my transaction cost because I've already capitalized it. And I also don't need to write down that year end gain or loss because that's to be recorded in the other comprehensive income. So that the only thing which will come in the income statement is your dividend income. The rest of the thing is in your other comprehensive income, and that where you will write it down. Fair value gain on financial asset, and that's going to be 1500. Again, it's an income, so I'm writing it down in negative. Okay, you can write it in positive, but then stick to your way of presentation. If you're writing expense positive, then write incomes negative. If you're writing incomes negative, then write down the expense positive. So likewise. And then this is it from the income statement and the OCI. But then I'm going to make up the extracts of the balance sheet for you. And under the non-current asset, I'm going to be writing down financial assets, which is investment in student company shares. And that will be at a valuation of 10,500, which we just calculated over here. You can see. Okay. And in the so that's in the balance sheet. And while you're preparing your equity, you know that you have to write down something called as other components of equity. In this other components of equity, you can write down your financial assets. Okay. And this will be, you have a gain over here of 1500. So this 1500 will be as a gain and balance over here. It's the same place. Now, this is one more thing which I would like to explain you over here. Be very careful that in the other components of equity, you also write down your revaluation surplus. So this is what I explained before also, that these are the two things which will be part of your other components of equity, apart from share premium, because share premium obviously is there. But you have revaluation surplus and you have financial asset. Now, this revaluation surplus can be this revaluation surplus can be a positive balance of something, or it could be a zero balance. Okay, either you do have a revaluation surplus or you don't have a revaluation surplus. But when it's financial asset, right now, see, it was a gain, so I'm writing it down in positive. But in cases if there is a loss, you have to write it as a negative figure. So in this question, what has happened is that the investment went from 9,000 to 10,500, but it could have been possibility that it would have went from 9,000 to, let's say, 8,000 actually. So I would have a loss of 1,000. That 1,000, while I'm preparing the my balance sheet, in the other components of equity, I'm going to write down 1,000 negative because it's going to reduce my equity. It's a loss. So only in the cases when it's a gain, you write it in positive. Okay, but this thing can be in negative. That's what I'm trying to explain you. That revaluation surplus, either zero or positive something, 10,000, 50,000, whatever. But that revaluation cannot be negative. But when it's cases of financial asset and you're investing in shares, there either the balance can be in positive because the share prices have gone up, or it could also be in negative, and that negative will be reflected in the balance sheet as a negative figure. Okay, you cannot put zero or you cannot ignore that. You have to write it down as a negative of 1500 or whatever it is actually. So with this, I mean, I hope I've done it, and if you have any question, please ask for sure.
All clear, sir.
Ashu, any question? Hanina, Salma? Okay, good. So this was the end of this topic. Okay. So this was the end of this topic when, as an investor, which was Irish company, and I have invested in your equity. Okay. So in this case, I had an option that I can do it either at fair value through PNL, or I can do it through fair value through OCI, depending on whether I want to keep your shares for short-term purposes and, take the benefit of gains, or I want to keep it in the longer run and maybe try to control your company in future if that's my intention. So we have different accounting treatments for both the intentions. Okay. But now I'm going to be investing in your bonds, like where you
So,
have an, yeah.
sorry to interrupt. What was the above question about? Like, was it equity or was it liability?
Where
The instance which you gave, was it equity or was it of liability? As
this one,
in
which we
what
did right
category?
now, this one,
Yeah,
which is,
yeah, yeah.
yeah, this I said you that it was equity because you were under no obligation to pay me any dividend. You did it. That was 0.5 per share. That was thanks to you. But in the contract, when I invested money in your company, in that contract, there was nowhere written that every year student company has to pay XYZ amount of dividend to Irish company. If that would have been written, and though you call it as equity, it's not an equity, then it's a liability for you.
Okay, okay, understood. As in question, it will be mentioned like every year you have to pay the dividend or whatever it is.
Exactly. You will see, like in financial
Okay, okay,
reporting,
sir.
let's
Okay,
talk
thank
about
you.
your exam. So we see, if it's ordinary shares written, you will understand that we are talking about equity. If it's written debt, for
Equity.
example, you will understand that it's a liability, right? But
Yeah.
it's written preference shares, that's where the confusion would be, that whether you should treat it as an equity or whether you should treat it as a debt. So you have to be careful with the information in the question, that what is it all about? Is it the company under an obligation to pay a fixed amount of dividend every year? If that's the case, then preference shares will not be considered to be as equity. It will be considered to be as a non-current liability. But if these are different type of preference shares where the company is not supposed to pay you any dividend, it's only the fact that whenever they will pay the dividend, they will pay it to you in priority to the ordinary shareholder. But anyways, the company is under no obligation to pay you the preference dividend every year. So if that's the case, then it becomes the equity.
Okay, okay, sir. Okay,
One
okay.
more thing is, see, like what I'm trying to do over here is just not to prepare you for the financial reporting paper. My way of teaching, or the way how I'm explaining you, is to make you sure and confident about your SBR paper, because in that paper nobody tests you that whether you are good in calculations or not, because you need to understand from the corporate level that calculation I can ask any junior accountant to do it for me. I don't need to worry about it. But as a director or as a corporate financial controller, if you're identifying the instruments incorrectly, how do you expect to be at that position then? So the
Yeah,
understanding of whether it's a liability or whether it's an equity, you need to look up at the contract. You need to look up at the terms and conditions of the contract. That's what I'm trying to explain you. Your see, anybody can do the accounting. You have softwares and everything will be done automatically, but that's where the human judgment is coming, that I need to look up at the contract and see that whether the investee is under any obligation or not under any obligation. It's a very simple straightforward question. Yes, there is an obligation for the investee to pay the investor anything. You call it dividend, you call it interest, you call profit, you call whatever name. Don't get yourself confused with the name. The main thing is anything to be returned. If that's the case, halas, it becomes as a liability. I mean, for you, it will be liability. And then I have different options to record it. But if it's your equity, then I only have two options, which is fair value through PNL and fair value through OCI. Now I'll explain you that if this would have been a debt for you, then what options I have actually. Hope that's clear.
okay. Yeah, yeah. Thank you, sir.
Okay. So now let's say Arish, now this is basically from uh, investment in debts. Okay. The first one was investment in equity. Now it's investment in debts. So in this case, okay, if I'm investing in your debt, I have three options actually. So there is one extra option which comes for the investor that I can use that option to record my investment in your debts. Okay. So the first option is amortized cost method, amortized cost. The rest two are exactly the same, which is fair value through PNL and fair value through OCI. Okay. Now I will give you a question actually. I'll give you an example, and with that example, I'm going to try to make you understand that what option to use and when. Okay, so let's see that on first of, let's say on 1st of January, okay, 2015, Arish bought. Now, do you see Arish bought? So basically, Arish is the investor over here. If it says Arish issued, it means that he is not the investor, he is the investee over here. So the word issued means the person or the company who's taking the loan or who's taking the money. Arish bot means the investor over here. So you have to be very careful in the question that from which angle are they talking about? Are they talking about the investor side or they're talking about the investee side basically? So on 1st of January 2015, Arish company bought a 10,000 6% bond, okay, for 9,000. Incurring acquisition cost of $144. You have an obligation over here. So basically it says on 1st of January 2015, Arish company bought a 10,000 6% bond for 9,000 from students company. So basically I have invested in your company through a bond, okay, not in your shares actually. Now this and I have also spent like 144 acquisition cost. Interest is received. Now you are under an obligation to pay me an interest annually by the end of the year. So it's annually and in arrears. Okay. And the bond will be redeemed. Like you will not only be paying me interest, okay, for a number of years, but you will also redeem back the bond to me. Like you will also give me the principal amount which I have given to you and will be redeemed at a premium of 500 over its nominal value on 31st of December 2017. So basically, it's an investment with you for 3 years, whole of 15, 16, and 17. Okay. And you will not only give me interest for all those 3 years. In fact, when you're going to return the amount back to me, and you will also be giving me a premium of 500. It's your legal obligation. If you don't do it, I will put you in the I will put up a case on you. I will sue you in the court. That thing cannot happen if I would have invested in your equity. If you are giving me dividend, good. If you're not giving, I can't do anything about it, about for that legally. Yeah, if I don't like your company, I can sell the shares and go and take my money. That's another story. But I cannot put up a legal, because I said you at the start of the class that when you're talking about financial instruments, you're talking about legal contracts basically. So if the obligation is there, the investor can sue the investee. But if the obligation is not there, it's an equity, and then the investor cannot sue the company. Okay. The effective rate of interest is 11%. Now I'm going to explain you each and everything. So just give me 1 minute unless I end up with this example, and then we can see the fair value of the bond was as follows. So by 31st of December 2015, like the first year end, it was at a valuation of 11,000. And at 31st of December, I mean the next year, 2016, it had a valuation of 10,400. Okay. So that's the information, or that's the data that they will also give it to you in the exam. Okay. Yes. And I told you that you have how many options you have over here? Three options: amortized cost, fair value through P&L, and fair value through OCI. So we have these three options over here. Now, please try to understand. You need to, like, I need to pass the investor, okay, has to pass two tests over here. One of them is called as the business model test, and the second one is called as the characteristics cash flow test. So you have these two, what do you call, models or tests over here. Now, the first one is business model test, okay. Again, it's all about intentions over here. I have invested $10,000 in your company. Okay. Here, this $10,000 in your company. Do you know that, like, how shares has a market price, bond also has a market price? Are you aware of this fact?
Yes, sir.
Others? Okay, good. So you do understand that the bonds do have a market value, like how shares have a market value, bonds also do have a market value. Shares value cannot go below the nominal value, but the bond value can go below the nominal value depending on how well or how bad the company is performing. Okay. Now try to understand business. Be careful with this word business. Okay. Now see, my I have given you $10,000. My intention is that you do business with that amount. With that $10,000, you buy whatever you want to buy and you do business. You grow your business. My intentions are not that if today, like I've invested in your bonds in the market, right? So my intentions are not that tomorrow, if if the bond price goes up, I'm going to sell the bond and I'm going to get a return of it. That's not my intention. The business model test means that the investor has given the investee, you guys, the student company, money for their business, for their trading purposes. I have no intentions whatsoever to sell the bond till the maturity. I have given this money to you for, and be very careful in the dates in the exam. I have given this money from 1st of January to 31st of December 2017. That's exactly for 3 years. I'm saying keep that 10,000, give it to me after 3 years. I will not sell your bond during those 3 years. You take that money, do business, make money for yourself, but give me the interest on time to me when it's due. That's it. If that's my intention, it means that the business model test has been passed. Okay. So business model test means that the investor has given the money to the investee for business purposes and not with the intention to sell the bonds at a higher market price before the maturity date. In this case, it's 3 years. If you have any problem with the business model test, please ask. Aditya, any question? Okay. Can I move further, right?
Yes, sir.
Okay. And do you understand that what returns am I supposed to get from here? Like as an investor, I'm talking about myself. What returns am I getting? From you, I'm going to get, you see, I'm going to be getting interest every year. Good. Right? Interest at 6%. That's what I will be getting. Very good. I like it. What else? Principal amount. I'm going to be getting the $10,000 nominal value after 3 years. And I will also be getting the premium, which is 500 more. Everything which I get is in terms of cash. If that's the case, it means that the characteristic cash flow test has been passed. The only returns from the investment I get is in terms of cash. If that's the case, it means that the characteristic cash flow test has been passed. Now, take this as an example. If by investing in your company, I get an option that I can appoint your board of directors, I can decide on your financial policy. Am I getting only, it's in the contract. Again, focus on the contract. This same bond, try to understand this point. The same bond, it's not only giving me cash returns, which is the nominal value, the principal, the interest, the premium, but it's also giving me an option that I can decide that who the hell will sit on your board of directors. If that's the case, the characteristic cash flow test has not been passed. So the only returns which I'm getting from this investment should be in terms of cash. And if that's the case, it means that the characteristic cash flow test have been passed. Okay. So means that the returns to the investor from the investment will only be in cash terms, which is normally the principal and the interest and nothing more. For example, option to participate in decision making. So if these two tests are passed, okay, then the option what I have, I mean, it's not an option, it's a fact that I am going to be recording this investment in your company in the shape of bonds at something called as the amortized cost method. If these two tests have been passed. The characteristic cash flow test and the business model test. So the purpose of giving you loan was to so that you can do the business. Number one, and I'm not going to sell the bonds and I'm not going to ask the money from you before those 3 years. That's business model test. Second, the only return what I'm getting from this investment is in terms of cash. Halas, that's it, nothing more. So if that's the case, the tests have been passed, and then I'm bound to record this investment at amortized cost method. Okay. I still have two more options, which is fair value through PNL and fair value through OCI. I'll come back on it later. But right now, what I'm going to be doing is that you did understand, and if not, you can ask the question. You did understand that when you have to use the amortized cost method, the information will be given to you in the question. And you need to understand that only if the purpose of giving the investment was for the business and the investor will not recall his investment before 3 years, the maturity period, and he will only be getting the returns in form of cash. That means both the tests have been passed and the investor will be recording this bond investment at the amortized cost method way. So if that's clear, you can give me a thumbs up and I can go ahead.
So either or the condition has to be satisfied or the
Both,
both condition has to
both,
be
both, both. And
both.
I'm saying and. I'm not saying or,
Okay.
I'm saying and.
Okay, sir. Okay.
Okay. So now we'll talk about how to record the amortized cost, but uh, if any of these conditions are not met, just because Aditya asked me a question, just to add it more. So here, if wait, Just give me 1 second. Okay, so this one was for both the conditions have to be fulfilled. If any one of the conditions have not been fulfilled, then the bond investment will be recorded at fair value through P&L. So if any of them has not been fulfilled, I cannot use the amortized cost option anymore. Then I have to use the fair value through P&L option. Okay. How to do it? That's the next part of the lecture. But right now, I'm just trying to help you to understand that what conditions and what criteria you have to fulfill in order to use which option. So if both the tests have been passed, as I explained you right now, you have to go with the amortized cost method. If you find any of the conditions not been fulfilled, then in that case, it's fair value through P&L. As far as your exam is concerned, it's likely going to be more focused on the amortized cost and the fair value through OCI, okay, with the debts I'm talking about. However, it doesn't mean that you don't need to know all three. You need to know all three, but this is what I'm telling you, that how the exam is actually. They will focus more on the OCI option and the amortized cost option. So first, let me help you out to do this question in the amortized cost way, and then we can go on with fair value through OCI and with fair value through P&L option 2. Okay. So now let's see with the amortized cost method. Right. So the initial measurement. Okay. It's written in the books or anywhere if you see it will be written the initial measurement is at the fair value. But I'm going to tell you, instead of understanding fair value, what you keep in your mind is the initial measurement of this investment in bond by Irish company and student company will be at the cash paid. Okay. So now please try to understand over here. See, it says Arish bought a 10,000 6% bond for 9,000. You understand this 9,000? There is something called as a discount over here, right? Like the bond says that a student company owe me 10,000, but I have not paid you actually 10,000. I have only paid you 9,000. So it is actually a $1,000 discount what you gave me just to attract so that I can invest in your company basically. So the cash payment what I have done is 9,000, okay? Not 10,000. But you guys tell me that as a student company that we owe Arish 10,000. So it's $1,000 which you discount. So that $1,000 is what you gave me as a discount. Incurring acquisition cost of 144. So I have to pay. You see, you understand this. What was the cash paid by Arish? That's the simple question you need to answer. So the cash paid by Arish was 9,000 and plus the acquisition cost, which was 144. So when I'm recording this investment, the initial measurement, it will be at debit, financial asset again, because for me it's an asset. And this is investment, not in shares, but this will be investment in bonds. And I will write down which company. So it's student company and debit will be with the amount of 9144. That's how you're going to start the transaction. And credit will be bank because that's the amount what I have paid. So that will be at a valuation of 9144. Any questions?
As in, sir, in amortized cost method, we have to recognize the transaction price too, right?
Yeah, now you can put it in other words, but the simple one is that when you read the question, you see that how much the investor has paid. That's it. I agree. Transaction cost will be capitalized. Yes. If you want to go in more technical term.
Okay, sir.
Girls, any other questions? Okay. So now after you have done with the initial measurement, okay, we now need to go towards the subsequent measurement. And for this, the best way is that you prepare a table. Okay. So we will prepare a table. It's for 3 years, so we don't need to worry about too much. I mean, it's going to be very short for us. Okay, so here you go. Now, this is the opening balance. This is the finance income, because you're talking from my side. So if I have invested money in your company, so I'm going to be getting the income. Then I will be getting cash because you have to pay me cash every year. And this will become the closing balance. Don't worry about it. I'm just going to explain it to you one by one in just a couple of minutes. And here, let me put up the years. Yeah. So first year, second year, third year. Okay. Now see, the investment will start from 9144. This is the starting position, or how you're going to, how Irish company will record their investment in student company, which they have done it in their bonds. Okay. And the amortized cost tests have been passed. No intentions of selling the bond, I swear. And I will only be getting the returns in terms of cash. That's it. So it will start from 9144. Okay. This finance income has to be recorded at something called as the effective rate. Now, just hold for a second, and I'm going to explain you that how did we get this effective rate and everything. So you would be very comfortable with this whole calculation, but you just have to allow me some time. Finance income at effective rate. So the effective rate in this question is given to you. The effective rate of interest is 11%. So this, how did this 11% come? So far you would have been assuming that the question is giving you, but no, there is a way of how to calculate it. I'll just explain it to you very clearly now. The so the finance income which you will be recording would be at 11%. The cash received is basically at the nominal rate. And every year you are supposed to pay me the interest at 6%. You see this 6%, this is called as the nominal rate, and the higher one, which is basically the 11%, that's called as the effective rate. So you will be always given two rates, nominal rate and the effective rate. Effective rate can be equal to nominal rate or greater than that, but it cannot be lesser than 6% or the nominal rate. You will understand it very soon now. So this is what I'm trying to explain you, that your income will be at 11 and this nominal rate will be at a rate which is 6% over here, and you will be getting the closing balance. Okay. So 9144, can you please apply 11% on that? So you will get the that's my income for first year. So it's 9144 into 11%. So it's going to be approximately 1006. We could have done it on Excel, but anyways, right now let's keep it on Word. Cash received is 6%, so that's going to be the amount which I've invested was 10,000, and you're going to give me 6% interest every year, so that makes it up to 600. Any problems or any questions so far?
No, sir.
Okay, so the closing balance over here will be 9144 plus 1006 minus 600. I'm going to get 9550. Okay, and I can do it. I mean, you can do it for the second year also, which is going to be 9550. And again, you will charge 11%, which is 1051. Okay. And then again, there is a I will receive 600 cash from you because you are paying me interest every year. So the closing balance which you get for the second year will be 10,001. And for the last one, it becomes 1100 over here. Now, please, for the last year, the last cash received, you need to be focused over here. What you're going to give me, you're going to give me the nominal amount, 10,000. You will also give me 600 interest, and you will also give me 500 premium. So after that, once I've got all these amount, my investment in you will be zero. Because if you see it's 10,001 plus 1100, so that makes it up to 11,101 something. If I forget about one, so it's 11,100 actually. And this is made up of 10,000 of the nominal value because that was the loan amount. You said that I'm going to give you 10,000 back. Discount was at 1,000 and I paid you 9,000. 600 you will give me for the interest for the third year, and 500 you will give me the premium which you promised also. So once all these amounts have been obtained, the investment value which I have in your company in bond will turn out to be zero. If you have any problem in this format, please ask. Okay. So now, any questions? Aditya, all good?
Yeah, sir.
Okay. Now, I have something for you over here just to make you understand more things better and to give you the entries also. Can you total all the incomes which have been recorded in these 3 years? The total of all three. 1,006, 1,051, and 1,100. So this
3157.
correct. 3,157. Okay. Three one five seven is the total income recorded in the 3 years. Agreed. Now the point is, let's reconcile it out. Okay. What was the income which I was supposed to get from you? The first income was interest income, obviously. Sorry. Interest income, which was 600 multiplied by 3. So that turns out to be 1,800. Any problem?
No, sir.
What was the next income?
Was premium.
Correct. Okay. So that was the premium. Yep. Which was 500. What was else? You gave me discount also, right?
Yeah.
1,000. So if you look up over here, total turns out to be 1,800 plus 500 plus 1,000. So it turns out to be 3,300. But then if you remember that you took some transaction cost from me also. less the transaction or the acquisition cost, which was 144, I believe.
Yeah.
Yeah. So 144 over there. So if I subtract 144, so 3300 minus 144, do you get exactly this 3157 or 3156?
3156.
So you do believe that this is almost equal to the total income being recorded in the 3 years. Do you get it reconciled? That's the point actually.
Yeah. Yes, yes, sir. Yes.
Okay. So this one, which we have recorded in 3 months, oh sorry, in 3 year, and this one also is also 3156. Now I cannot record any income because see, you gave me discount in the first year, you're giving me premium in the next year. So as per the accrual basis, all this three income together will be recorded in 3 years actually. You cannot write down 1000 income in the first year because you got it in that year and then 500 in the last year and 600 every year. No, you're going against the concept of accrual accounting. That's why we use amortized cost, because these are the three incomes. I mean, 3156 is the income for 3 years. So that's how am I supposed to record it in those 3 years. Like that's like in the first year, I'm going to be recording it at 1006, then 1051, and then 1100 actually. Hope that's clear.
Yeah, sir. Yeah.
Girls, does it make sense now to see the reconciliation and everything? Okay. And there's one more thing which we need to figure out, that 11 percentage. Okay. See, how much did I invested in your company? Like I'm getting 3156. Okay. But the investment which I did was 9,000 the loan and 144 the acquisition cost. So if I divide it like 9144, okay. So I basically got 3156 on my investment of 9144. So if you see, it will come 34.5 percentage actually, and that was for 3 years. So if I divide by 3 years, you can see you will be getting 11 percentage actually. Round about 11.5 percentage. That's it. So it's the effective rate of interest was 11 percentage. Now you see the nominal rate is 6, but the effective rate is 11. It increased by 5 percentage. My income increased by 5 percentage. It was instead of 6, it became 11 because you were giving me discount, you were giving me premium. So that's why the effective, the actual rate of return for me is not 6 percentage, it's 11 percentage actually. That 5 percentage increase is shown by the premium and the discount, obviously net of the acquisition cost. So that's the 5 percentage extra what is my return, because you're giving me discount income and you're giving me premium income also. So the nominal, if they wouldn't have been transaction cost, premium, discount, then the nominal and the effective would have been the same. But because there is a discount, there is a premium, there is an acquisition cost, that's why the effective rate of return from my side, it's my income. For your side, it's your cost. Okay. 11 percentage is an income to me. 11 percentage is a cost to you, because you are the investee. I'm the investor. It's higher. For you also, the cost is not 6 percentage. For you also, the cost is 11 percentage, 11 point something. For me also, it's 11 percentage return, because I am getting premium and discount and not just the interest of 6 percentage. You also have to pay the discount. You also have to pay the premium. That's why the cost to you is 11 percentage actually. Hope that's clear.
Yes, sir.
Girls, any question? Okay, good. So now your exam. if you will see in the trial balance that the balance of this investment is 9550. So for the first year, they have already calculated. What you have to do is for the second year, for example. That's it. Or they can, I'm not saying that they will just ask you directly for the second year. They can also ask you to record it for the first year, or in some cases in constructed response section C type of question, they will tell you that the balance was at 9550, but then the accountant forget to pass the entry for the second year, and now they are calling you for the second year. So you just need to do for the second year adjustment. That's it. So this is how the section C response question can be. But in MCQ, I mean, obviously they can ask you anything out of it actually. But this thing which I have done for you, this was just an explanation and to make you confident that how the amortized cost method works and how did you get that 11 percentage and how is the total income of 3157 to be recorded in those 3 years actually. So this is not from the exam perspective, but this was just purely for the sake of your understanding so that you understand the amortized concept kind of more clearly. But then you have the entries, which I would advise you that you remember them. So you see for the income, here, have a look, please. This finance income, you know that it's basically going to be in your income statement, right? So this is part of the income statement. Whatever cash you receive, this is obviously going to be part of your cash flow statement. And this closing balance would be part of your balance sheet because there it will be shown. Okay. So you need to understand two more entries. One is for the how to record the income and then how to record the cash received basically. So for the income, it's a simple entry. It's going to be debit, financial asset. Okay. And credit will be income statement, finance income, like with your interest expense and interest income there. And when you got the cash, it will be debit, cash or bank, and credit, it will be financial asset. So automatically you will get the closing balance, which you will reflect in the balance sheet. Okay. So let's suppose if I need to pass the entries for the first year, it's at 1006 and 600. So I'm going to say my asset increased up by 1006 because of my accrued income. And that I'm going to be recording it in the income statement. Then once I got the cash, I'm going to be happy with $600 cash. And I'm going to reduce my financial asset with the amount of 600. So these are the entries specifically for the first year. If you have any question, please feel free to ask.
All good, sir.
Girls, okay, perfect. So now let's move towards the next part, which is fair value through OCI. Okay. So we did with the amortized cost method. Oh, wait. Now I am coming to fair value through OCI. Okay. And then I will come back again to fair value through PNL. Right. Now, I'm asking a question from you, okay? And you tell me that is it fair to me or is it not fair to me? Like in 3 years, if you look up with the same question, okay, how much return I was getting overall? Like overall return, I was getting around 34 percentage basically, okay? Now, do you think it's fair to me that let's suppose if an other student company offered me 40 percentage return, should I stuck my money with you for 3 years or should I take out the investment from your company and put it somewhere else where I'm getting more than 34 percentage?
We should invest in some other company where we are getting more returns.
Technically, that's what the mind is, right? Yes. Okay. Girls, what do you believe? Yeah, we should. But okay, listen, it's not necessary. Yeah, okay. Everybody has the same answer. So you're believing that if I get more return, I should sell the investment from your company. Like I should sell the bonds, get the money, and invest it somewhere else where I'm getting higher return. Now, see, it all depends on the intentions. I'm telling you, it's all intentions and it's all contractual. Okay. So let's suppose if that's my intention, then I cannot do it on amortized cost method. Okay. In that case, I'm going to be doing it at fair value through OCI. See, see the wordings basically. My intentions are not to sell the bond. My intentions are to give you the money for 3 years. Okay, so that you can do business, and I will not call the funds before 3 years. Like I'm not going to sell the investment. However, if higher returns are available, I might sell it. I'm still saying that I'm not sure. Okay, I'm saying if higher returns make become available for me, I might sell that investment. If that's the case, then as an investor I cannot record this at amortized cost method. I am going to be doing it at fair value through OCI. Okay. So that's the case when you are doing for the fair value through OCI. The characteristic, now let me, I'll write down this thing again for you. The characteristic cash flow test doesn't changes at all. Okay. For the fair value through OCI here. This part doesn't changes. This means that this part is only where the difference is. This means that the investor has given the money to investee for business purposes and not with intention to sell the bonds at a high market price before the maturity date, which is 3 years. However, sorry. However, if more returns are available, the investor might sell the investment. So this is the business model test when you are talking about fair value through OCI and not about amortized cost method. So that's where we talk about fair value through OCI. So the characteristic cash flow test remains same. It doesn't changes. It's only there is a slight adjustment in the business model test. It starts with the same intention as we did it for the amortized cost method, that we are not going to be selling it. However, there is a condition over there that in case if somebody offers me more than 34% return, I will sell the investment from you and I'm going to be investing it somewhere else wherever I'm getting high return. So if that's the case, you have to use, like for me as an investor, I have to use the option of fair value through OCI. Hope that's clear. Any problem in to decide when to go with amortized cost or when to go with fair value through OCI? Fair value through PNL is very simple. If these cases are not met, any one of them, khalas, it's fair value through PNL. But if these two conditions are being fulfilled, then you have amortized cost method and fair value through OCI. Amortized cost method, business model, no chance of selling. Fair value through OCI, chance of selling if higher returns are available. It happens or it doesn't happen, that's another story, but the intentions are that they might sell it off. So if you're clear with the concept of when to use which option, you can let me know and I can show you how to calculate for fair value through OCI.
All good, sir. All good.
Girls, any questions? Okay, good. So in this case, okay, so like you see here, we did the initial measurement, okay. So for fair value through OCI also, the initial measurement is exactly the same. So I'm just copy pasting it. So either you are in amortized cost method or you are in fair value through OCI method. The initial measurement will not change. It will remain same as like 9144, which is how much amount you paid, like how much amount Arish paid to invest in your bonds. Okay. So that was 9144. But here, okay, I'll just copy the question again so that it becomes easy for you. Now for the subsequent measurement, okay? So initial measurement is exactly same. Either you're going with fair value through PNL or you're going with fair value through OCI, okay? But the differences which will be there, I'm going to explain you shortly. Here we go. So this was initial measurement, which I've already put up for you, the entry. And now it's basically for the subsequent measurement, okay? Now please try to understand for subsequent measurement. Here, you need to add up one more column. The initial measurement will be same at 9144. Okay. The effective 11, this column will remain exactly same. You don't have to change it because the income which I'm getting from this bond investment is 3157. For the first year, it was 1006. For second year, it was 1051. And for the third year, it was 1100. So you don't have to change your first column. Also, it will be as it is. Okay. Here we need to change this. Here we need to change this. Yeah. So I'm in the first year. No problem. 9144, same as it is. 1006 for the first year finance income, same as it is. Cash received 600, agreed. Same, no difference. So as per this calculation, what is the value coming up actually? So 91, the value of my investment, 9144 plus 1006 minus 600. So it turns out to be 9550. Okay. But at the year end, you need to calculate that what is the fair value of this investment. I mean, you don't need to calculate, the question will be telling you, and that's here. This part of the question was given to you so that you can use it for fair value through OCI. Apart from it, I don't need this information. If I'm doing with amortized cost method, I don't need this information. The question would have ended till 11 percentage. But in case when the company has a policy of going through fair value through OCI, the question will provide you the fair value of the investment at the end of the year. So by the end of the first year, the investment has a fair value of 11,000 actually. So what I'm going to do is that this is the closing balance. It will be 11,000. Fair value at the reporting date. Okay. And you see that the fair value has gone up from 9550 to 11,000 actually. Okay. So this will give me something to be recorded in OCI. In this case, it will be a gain of the difference, which is 1450. This gain will be recorded in the OCI. So when you are valuing the investment in bonds at fair value through OCI, you have at the year end, you have to see the fair value of your investment. And in case if there is any gain or loss, that will be recorded in the OCI. That's the only difference over here, basically. If you have any question for the first year, you can ask, and then we can move on the second year. Aditya, any problem? Girls?
No, sir, no, all clear.
Okay. So now let's look up for the second year. They have just, in this question, they have just given you the till second year. So we won't be able to do it for the third year, because by the third year, it would have been assumed that they have sold it off actually. Okay. So we'll just do for the 2 years. And here you see now the opening balance will not be at 9550 what we were doing before. The opening value of this investment will be at 11,000. However, this is what I'm trying to explain you, that these values will not change. I mean, I don't earn income based on the fair value. Okay. The incomes are 13157 in total, and for the first and second and third year you have to calculate as per the amortized cost method. So in case if the question is where you have to do through fair value through OCI amortized cost method, by default you have to do, because the amortized cost method will actually tell you that how much income you have to record in all the 3 years respectively. Okay, so through amortized cost method here I can only get to know that how much income will be recorded in first year, second year, and third year. Okay. So if the question is all about fair value through OCI, and don't worry, like in FR, they won't ask you in that detail, but it's there in your syllabus. So that's why telling you. But yes, definitely in SBR, when you get these type of questions, you will have to work through amortized cost and then through the fair value through OCI. So it's still there. Okay. So 11,000, and then this will remain same minus 600. So now, as per this calculation, the balance is 11,000 plus 1051 minus 600. So you get here 11,451. But if I look up at the fair value by the end of the second year, it's only 10,400. Okay. So 10,400, it means that the fair value has gone down and it will be considered to be as a loss, and there will be a loss of 1051 for the second year. Any problem with the second year?
No, sir.
Girls, all good? Okay. So now, let's say by the third year, I sold the bond, for example. Yeah. So now you see, now the bond is at 10,400 in my books. I'm going to be selling it off. Let's say I sold it for, the bond was sold, like I'm giving this information from my own end. The bond was sold for 11,000 by the start of the third year. So that's it. Then you sold the bond, like I sold the bond, I'm the investor. So I got the cash of 11,000, and the bond was in my books. The financial asset was in my books at 10,400. So I made a gain over here of 600, and that will be recorded in the income statement. Gain on disposing of the bond. Because we talked about fair value through OCI, and that's the case when we are not going to keep the bond for the entire 3 year. But just because after the second year I got high returns and I sold the bond, so whatever the fair value is, how much money you got and how much the bond was in your books, you will remove it and you will record the cash, and the difference will become a gain or a loss in the income statement. That's all. Clear? Any problem?
No, sir.
Okay. Now, lastly, what we have over here to end up with financial asset is, if there is at fair value through P&L. So I already explained you, if any of the conditions are not being fulfilled, okay, either it's your, if any of the conditions or tests are not fulfilled, Okay. We simply record the investment at fair value through P&L. I have to write it over here. Yeah, I mean, it's already written. Good. If any of the conditions have not been fulfilled, then the bond investment will be recorded at fair value through P&L. Okay. So if that's the case, okay, so I'll just do it for 1 year so that you get an idea that what would be the transaction in case if it is through fair value through P&L. Okay. Just give me a minute. Okay. So in let's say that if the conditions are not being met, okay. So and that way we have to do it through fair value through P&L. So in this case, the first difference is that the transaction cost will not be capitalized. Okay. So the initial entry will be debit financial asset. Like I have invested in your bond, so it's an asset for me. Investment in bonds, that's the student company, and it will be at 9,000. Credit cash with the amount of 9,000. That's the initial entry. Here it's different. There we were debiting by 9144, but now in this case we will debit only by 9,000. The rest 144, which is the transaction cost, I'm going to say debit my income statement because it's an expense with the amount of 144, and credit will be cash with the amount of 144. Any problem with these two transactions?
No, sir.
Clear, girls? Okay. So, and then during the year or by the end of the year, you gave me income, you gave me interest, right? So that was 600. So I'm going to just simply say debit cash with the amount of 600, and credit will be my income statement. That's basically interest income with the amount of 600. No table, no nothing. Simple, straightforward. When I buy your bond, whatever I paid for it, I record, I debit it. If I pay transaction cost, I put it into my income statement. You give me income, I record it, cash debit, income credit, simple. But then by the year end, I have to bring the investment at fair value. So if you see that I recorded it at 9,000, but then at the first year end, the fair value of this investment is at 11,000. So I made a gain of 2,000. So that gain will be gain, or we can say remeasurement at the year end. Okay. So it will be debit with the amount of financial asset, investment in bonds, student company, and it will be with the amount of 2,000. And credit will be again my income statement because it's fair value through P&L. It's not through the OCI. Okay. Income statement and fair value gains with the amount of 2,000. That's all in this then. Any questions?
No, sir.
Girls, all good? Okay. So here I needed to just tell you one more entry. Whatever gains and losses you are taking into the OCI, okay? Because we did understand the entry for income and we did understand the entry for cash received. However, the entry to record the gain and loss arising at the fair when you're putting it at fair value at the year end was supposed to be treated in OCI, right? So for the first year, here, wait. Yeah. For the first year, when it was a gain, I'm going to say again, debit my financial asset and it will be a credit in the OCI with the amount of 1450. However, in the second year, it was a loss. So I'm going to say debit OCI with the amount of 1051 and my credit will be my financial asset. So in that times you are putting every loss and gain into your uh, OCI. That's the only difference what you have. Okay. So first year it was a gain, so you credit OCI, but then by the second year it was a loss, so you were going to debit the OCI in that case. Okay. So we'll keep it till here. That's all in the financial asset topic. What is left in this syllabus in your chapter is how to record financial liability. But I'm pretty much sure that financial liability is it's just going to be the opposite of your financial asset. So you just I will be doing it from your side. Okay. So there's no big differences when it comes to financial liabilities. And normally 99 percentage all financial liabilities are to be recorded at the amortized cost method. So if you have understood the amortized cost method over here, it won't be a big problem for you to understand in the case of financial liability. And then you have one more thing, which is compound instrument, which has like the characteristics of both the equity and the debt. And there's the third topic, which is also de-recognition of financial asset. So these three topics won't be taking too much time. I can do it tomorrow again, like same time, and we can end up all the remaining three topics. So after that, I really don't believe that this chapter would be a problem for you, and you will be able to do good in the exam. If you have any question, please you can ask. Is 5 UA time like how it was today good for you for tomorrow?
Yes, sir.
Or if there's a prayers thing, so we can make it 5:30 also. That's fine. So 5 good?
Yes.
Perfect. So inshallah tomorrow we can do at 5 and we will complete this the remaining. They're very small topics. I might just take 1 or 1.5 hour and it will all end up actually. But meanwhile, do revise this, whatever we have done. I'll share the recording, I'll share the Word document. And tomorrow I will also share one question with you. Like it was, as I told you that I had it from the past exam. So you will see that how this whole topic, whole chapter came up in section B, MCQs type of question. And you can also accumulate your doubts and your questions as far as this topic is concerned, either from section C, A, or B, whatever. And we will be discussing about them also too. Thank you very much.
Thank you, sir.